You will show the pigeonhole QR code later.
No, Mel. Actually, the QR code, actually, the guy actually can direct key in the questions there, so they know how to.
Okay.
Yeah.
Okay, so I don't have to say anything about the pigeonhole.
Ma'am?
Correct.
You may start.
Hi, good morning, everyone. A warm welcome to everyone here. I'm Melinda Sam from the Securities Association of Singapore. It is a warm weather as well, right? Now, thank you for spending your beautiful Saturday morning with us, and welcome to the first panel, Vision 2024, Market Predictions and New Strategies for the second half of 2024. Right. You have heard from Mr. Chan Kam Kong, Managing Director, Head of Research and FinLead Securities at Singapore Exchange, about the market, the economy, and so forth. Now, the market outlook for the second half of 2024, it will be shaped by several factors, including inflation, interest rates, economic resilience. In the first 6 months, we witnessed impressive gains in the stock market, and driven by strong earnings, the unstoppable rise of the Magnificent Seven stocks, and also investments into AI. Now, let me give you some thoughts to ponder. Number one, inflation in interest rates. Are they going to be here to stay? With the GDP report, would it give the Fed Reserve a soft landing and a boost to stocks? What's the global impact on other economies? Will it lead to increased financing and business costs? The next point, geopolitical risks such as trade tensions, US elections, regional conflicts, would it influence market dynamics? And the third point, what kind of strategies can you adopt to navigate geopolitical uncertainties? Fourth, what are the key predictions to the second half of 2024? Would there be continued stock momentum? Now, for the Singapore market, it is expected to benefit due to the heavy weightage of the 3 local banks and the high dividend yields. Stocks are now trading at relatively low PE ratios, suggesting there's still potential upside. Will high interest rates impact the Singapore stock market? Would it affect the overall dividend yield in Singapore? Will the rate changes influence investor sentiment in Singapore? And the last point, what diversification strategies that will be effective? While there are opportunities, there are also risks to consider. Now, let us begin by welcoming our 2 renowned panel speakers, Chua Han Ting, economist from the DBS Bank, and Song Seng Woon, Singapore Economic Advisor at CGS International Securities. I will definitely ask them questions to get their valuable insights. Right. Our esteemed panelists will shed light on their insights, the strategies, and what sort of strategies that you can explore to navigate this dynamic landscape. I encourage active participation from all of you. All right. Maybe the first question, I will throw it to maybe Han Ting. What are your views on the market outlook for the second half, and also maybe you can go even beyond the second half into next year? Yeah. Who would like to take the question? Yeah.
I can take the question first, Melinda.
Han Ting, okay, good. Han Ting, your turn.
Yeah, Melinda, thanks very much for that very comprehensive overview. I think for the market outlook, there's basically an inflection point has been reached. I think not only for the Singapore market, but for the global markets as a whole, we really have to look at what's happening in the US economy. And particularly, I think you mentioned about things like inflation, interest rates. I think we really have to take a look at this inflation progress so far. I think first half of the year, the progress has been a bit sticky, but over the past few months, I think what the Fed has called good progress is starting to emerge. So I think investors can look out for potential interest rate cuts by the Fed. And what does this mean for the economy? I think for the US economy, we saw the latest GDP print recently for the second quarter, 2.8% annualized growth. Half of that from what we've seen in second half of 2023, but still by and large quite resilient. A soft landing is sort of expected, no recession, I think. So markets should be kind of supported, but in the next few months, we really have to watch for some uncertainties with regards to, say, US election race, and that could see markets being volatile. Seng Lun, will you agree with that?
We say everything already, so I'll just add a bit more in terms of looking back. I think one thing we can certainly say is that unexpected event, market volatility is certainly something we have learned to live with. So sometimes making market prediction is high risk because they can be all over the place because of an unexpected event. Certainly has been the case if you want to look back. Let's begin since the US election is coming up again in November. Back in 2016, Donald Trump presidential term one, I would say. I would say since then, trade war, geopolitical tensions has risen. We have seen many other events in terms of war, unexpected shock in the form of COVID recovery, uneven COVID recovery. We've got expectation of a recession, which didn't materialize, expectation of interest rate in anticipation of recession. As Hunting pointed out, the global economy, US, continues to be resilient. So that's the backdrop, which I think we have to be mindful of, in that while Hunting and I, we talk about prediction and outlook, be ready for any other unexpected shock that could still essentially throw our prediction out the window. So I would essentially at this point just say, fingers crossed, toes as well, in that we appear after a very aggressive series of rate hikes over the past the couple of years, which looks like we had peaked in this interest rate cycle for this economic cycle that we are looking for, and certainly more central banks had already started easing, I think with the exception, if we will look at it, the Fed, the Bank of England to follow, and that would on paper be very accommodative against a backdrop of still resilient growth. So on paper, it should be still fairly positive if cost of borrowing is going to be coming down further. So borrowers can look forward to that cheaper cost of funding, companies as well. The only question is, will consumption, global growth remains resilient enough? Because I think the one thing which we may talk about a lot more later on is the series of aggressive rate hike. The impact may not be fully felt just yet, in that while we look back at, say, the US economy, so the largest one, continue to deliver on the spending side, perhaps the lag effect hasn't been entirely felt. If that is the case, then what would be the scenario should rates doesn't come off as quickly or job opportunities start to fade away? Because currently what is encouraging is that we still see job creation. The jobless rate claim in the US, the weekly claims, remains at relatively low level, unemployment rate at multi-decade low. So for the incumbent, the Democrats, it should be a positive macro backdrop, but obviously a lot of things can still change on the many fronts that Melissa and Hunting talk about as well. I'll stop here, pass it back to you, or Hunting or Melissa.
You talk about some uncertainties, some black swans. Do you agree, Hunting? Do you agree about this?
As I think I certainly agree on that. We are living in a more volatile world, whether it's from COVID shocks, and I think more recently what I've seen a lot is geopolitical uncertainties. The Russia-Ukraine war that has happened in 2022,
that's not going away anytime soon.
That's not going away. In fact, it's resulting in all these Red Sea crises, right? Diversion, port congestion.
Freight rates.
Yeah, when I go to Singapore, I see wow, so many ship, the port, so many ships gathering there. Although I think recently, MPA and our port authorities making quite a lot of efforts to relieve some of the pressures there with rescheduling or all that. But another big thing is also the US-China trade tensions, and it's not just US against China. US, EU is also coming into play. Different products that are being targeted, semiconductors, EVs now, and also you think that Mexico, Vietnam is benefiting a lot from this supply chain reconfiguration. Now Mexico is in their crosshairs. Yeah, so US election coming up, maybe more protectionist stance going forward. Maybe Vietnam would also be one of the countries that might be affected. So this is something we really have to live with it, right?
Yeah. And yeah, I mean, we were just following from that point. Trump, in his, I suppose, 2.0 term, even before that, he's talking about tariff on the freaking world. China tariffs 60%, the rest of the world, including from 10% more. So how it will play out, or whether it's just rhetorics, are all risks which are kind of mindful of. But again, there's one thing we can say about the Trump and his policies is he tends to talk a lot, whether it's about threatening to weaken the US dollar or slapping increased trade. So when you have that kind of backdrop for investors, what can you do at this point? I said navigate, it seems, day to day, depending on what's happening on the market front, on the data front, what's happening as announced on the geopolitical front, or just any other external shock or otherwise. Now, I suppose it's focused on the earnings side, where we have seen some doing better than the others, benefiting from high interest rate or stable interest rate, or consumers still spending, allowing company to pass on the cost to consumer. So lots of things to watch out for beside what's happening on the macro front. And on the macro front, obviously policies post-November election could also be different from the US Central Bank, because it also depends on what kind of fiscal policy get rolled up come next year as well. So we can have scenario 1, 2, 3, 4, up to 5 and more in the next few months to discuss on what kind of assumption we want to make on the macro background alone. Yeah. Headache in this environment.
About the trade tensions now, the escalating trade tension between US and China. It should Donald Trump be elected, I feel that it will escalate even further. How would this affect the market dynamics? Maybe who want to take the question?
Hunting. No, I just finished talking, so I'm not hunting again.
Okay, Hunting, you take a rest. Hunting, your turn.
Yeah, so I mean, these trade tensions is something going to be something that is quite problematic for the global economy. But just want to point out that, stepping back and looking at the US presidential elections, how markets have done usually in just looking at the S&P, when we saw the lead up to US presidential elections, usually it's a period of uncertainty, you see. So mid-August to late October, so the elections are in early November, right? If you look at the seasonality of it, from 1952 to 2020, actually that's a period of pullback. But subsequently, I think when you look at, after the elections, markets tends to hold up. I think some of the, whether it's a Democratic or Republican victory, they tend to want to roll out policies that are still growth supportive. So I think for markets, it tends to be up. And it's more important to look at what things will contribute to whether it's a recession is coming or not. I think that's probably one of the key questions for the market to decipher.
Yeah, I think that's really the thing. I mean, for for the current administration, I think the encouraging macro backdrop in that while the economy has lost a little bit of steam, it should be because the U.S. Central Bank has tightened monetary policy, raised the cost of borrowing. So that, from an economic standpoint, should be seen to be applying brakes on the underlying growth momentum, and job creation now is just returning to sort of a pre-pandemic kind of hiring in a normal macro backdrop, yet we're still seeing more jobs being created than lost. Jobless claim, as I say, remains relatively stable, and anyone who wants to find a job can do so. Unemployment rate at 4 decades low. So on paper, that should be supportive. Doesn't look like sign of a recession is around the corner. And if we are going to be seeing both parties, I would say spending in the campaigning side in terms of the months leading up to the November election, that spillover from election spending should also be mildly stimulative, I would say, especially heading into the year-end sort of festive spending mode, especially since and if labor market condition remains supportive. So on paper, it should still be supportive, like Hunting say, of the underlying markets, although we may have periods of volatility. Currently, if you look at the US markets, we have seen some bit of a pullback after a great run. It should, but it cannot just go on forever. And we have seen some, I suppose, spread into the smaller cap stocks as well. So if this can be supported by macro fundamental, i.e. just income spending, while job creation remains stable enough, I would say it's encouraging. The only thing which we don't know is what kind of rhetoric can come through in terms of electioning or electioning posture and what get implemented after that. We don't know what kind of more, I would say, outrageous claim could still come from the Trump camp, but whether they still continue, say, talking about the dollar being too strong. Actually, on that front, the reality is that if US were to cut rates and catch up with the rest of the world, we could see the dollar itself softening without having the Fed to do anything. So Trump will say, yay, but again, Trump is Trump, so he can say he do anything on that side. So these are just examples where the market strategy could swing upon just whatever get uttered from the two sides, well, especially from the Trump camp, because I would say if Kamala Harris do get the domination from Democratic side with the convention coming up, policy continuity will likely be the case from her administration, certainly in the early part of the term, but whereas from a Trump side, it could still be a far more volatility and more aggressive and on paper bad for global trade if the tariff hike were to be, I suppose, widened and intensified.
Thank you. Yeah, we will come to that and we'll give you your take on the U.S. presidential election later on. Now, let's come on to the interest rate, the Fed hikes, and also how yesterday MAS has also announced a change, no change to its monetary policy, right? And the Fed Reserve is also planning a rate cut, next month and in September. Now, give us your take. What are your views that were on the Singapore inflation side? Maybe Hunting. Let Sing will take a rest.
I can certainly talk a lot about this. So I have some slides that's prepared. Maybe we can pull it up now.
A good time to use the charts now.
Yeah, people like to see charts, right? So perhaps
our face too ugly lah.
Perhaps let's go to the next slide. So I think we talked a bit about a couple of things, but some of the economic themes that we are looking at, I think Melinda also mentioned, is about the inflation picture and lower interest rates. So let's look at the next slide, right? So lower interest rates, yeah, we are, I think at DBS, we are expecting lower interest rates from the Fed potentially in September, after being holding at decades high at 5.5 since they kept rate steady for about a year now, I must say. And if you look at the right chart here, I would like to point out some of the market pricing. So at the start of the year, markets were very exuberant, right? But I think that has pared back, and 2 cuts for this year looks kind of reasonable. And then we can have about 4 cuts next year. I think because Singapore interest rates, if you look at the left chart that I have here, tends to be quite correlated to the US. So if the US Fed cuts interest rates, then you could see, Singapore interest rates, SORA, your T-bills come down a bit. So for people that are looking at T-bills, you probably have to be aware of reinvestment risk. I think the ability for, lower interest rates also come from the inflation picture, which I can show on the next slide. And Singapore is a global price taker, so the inflation picture is should look quite similar to what we have seen globally, except maybe for Singapore, there's some things that are special to Singapore, such as the GST hike that we've seen over the past 2 years. But by and large, if you look at the left chart that I have here, inflation in Singapore has come down from, so core inflation here come down from 5.5% in January of 2023 to now slightly below 2.9 as of the June figure. Imported inflation is contained. The issue is services. Like many advanced economies, labor market is tight. So I think, Melinda, you also mentioned about the MAS policy that we had yesterday. MAS continued to keep its appreciatory stance on the Sing dollar nominal effective exchange rate. To be easy on listeners, this means what Sing dollar is against its trade weighted partners, so say Malaysia, US, for example. And here you see the chart shows that Sing dollar is quite strong and should remain quite strong, I think, given the MAS policy. But I think the MAS also acknowledges that the inflation picture is getting better. It has come down quite a bit. So that's quite similar to some of the things that are mentioned, I think, on the US side as well. So I think that's what we see on the inflation, interest rate side of things. And I think by and large, if you look at the next slide that I have, Singapore's economy is starting to turn around, and I think we can touch a bit more on this later on.
Okay. Now, Singwon, you want to add anything to add?
Yeah, I suppose, just to add, I get back to the exchange rate side. So for now, I suppose the key thing that we policymaker look out for here is underlying growth momentum. Where is it? It's a little bit uneven still, so which is why we saw that even within manufacturing, you see the uneven performance. First half of the year, it had been dragged down by pharma. Pharma mix certainly have changed post COVID in terms of what are the vaccine demand that's required. We have seen certainly that being weaker than expected as product mix are being changed. Within tech, semiconductor demand, although has recovered, it's also somewhat uneven as well. But when we look at, broadly speaking, services side, it has been doing a lot better. And clearly, whether it is Singaporean or resident traveling abroad on the back of strong Sing dollar or heading to Japan, because at one point this 1 Sing dollar by 120 yen, and people are still likely to expect dollar to remain strong, as Hunting points out. That we are still looking at ways to contain imported inflation, with the Sing dollar essentially still on depreciation path, or mildly so now. So economy is on the right track, coming in at the high end of the government expectation, despite the somewhat uneven performance of manufacturing so far. On the inflation side, it's also heading in the right direction. Headline coming up, services is the one that's providing, the services demand remains strong, and certainly we have seen service inflation due to just the resilient still labor market. So all in all, it would suggest the Singapore economy is still doing well enough, and the central bank confident enough in general, year on year, unless we see a huge external shock or shipping costs and freight costs continue to climb. At least on that front, it looks like when we look at the more recent data on freight charges, how much it costs to ship goods from west to east, east to west, that has gone up something like 3 times from end of last year, but it appears to have picked up for now. So fingers crossed, it won't get passed on to us, you and I, as consumer, as higher costs in more significant manner later on, but obviously time will tell. So all these things, I think, are playing out and impacting on monetary policy decision makers in the coming months. But I think by and large, Hanning and I, we all agree that the worst of the inflation may have peaked. Coming down, headline seems quite encouraging. There's still some stickiness in just core inflation or the services side, which makes central bank a little bit more careful, whether it is in the US or even here in the rest of Asia as well. So the macro backdrop, I think, still remains encouraging, with likely interest rate trend going to be down rather than up. And that in turn, if supported by resilient labor, as I said before, condition should still be supportive of consumption. Enough consumption to keep earnings going at some point. Is really just whether margins and etc. can be maintained, protected, or we will see impact on margins of companies as profits, etc. going forward.
Yeah, thank you. Yeah, you have painted a very, kind of rosy picture for us, especially with the strong Sing dollars, and it will be very good for people who are traveling out of Singapore, right?
I'm planning to go to Japan again.
Yeah, I think I'll go again, given how cheap it is, right?
Yeah,
Yeah, it is. I mean, the latest, I think I saw in today's news that the Changi Airport, in terms of passenger throughput, is back to almost back of passenger sort of handle. Excuse me, the volume of passenger handle is almost back to pre-crisis level as people come through. So that to some extent is also good, but yet at the same time, it also gives some worry for policymaker, because even though cost of borrowing has gone up, cost of living has gone up, still got money to spend and to travel, whether you are in Australia coming through or from Europe and whatever, going here for holiday, or from Singapore going to Korea, Japan as well. Good, but also a source of concern as far as pressure on prices coming from the services side. So that may means that, sorry, one final point on the interest rate side. Sure. That may means that interest rate cut, if they were to come, may not be as aggressive as what people are expecting now. So coming back to the US side, next week, likely to hold. Expectation is September cut. Will they cut and hold until after the election get reappointed, etc., in January, when fiscal policy are clearer, or will they cut again, or will they be cut in one time and then hold because the US economy is still resilient? So all these are the different paths that could still, for the interest rate, and much will depend on what happened and the outcome of US policy, US election, and what kind of policy get rolled out as well. Okay, back to you, sorry.
Okay, let's talk about the market prediction, right? I think most of the viewers here would also like to hear from you with the US election. What's the impact on commodities, equities, gold, the US dollar surging, right? And with this US presidential election coming up on 5th of November, what is your take on the impact on all these commodities, equities, etc.? And will US dollar continue its trajectory?
I think you first.
Yeah, always me first.
And you're younger.
Yeah, so
Yeah, you're younger.
yeah, very happy to share this. So yeah, the US election is coming up. So I think, for the US equities lead up to presidential elections usually quite volatile for markets. So I think expect some volatility. But I must say the race is still wide open for the US presidential election. So I think a couple of 1 week can be a big change in US elections, right? I think initially after the debate between Biden and Trump, we saw that Trump's popularity really picked up and his probability of winning has picked up tremendously. But then since then, I think Biden faced quite a lot of pressure. So he has eventually dropped out. Now Kamala Harris has come in, being endorsed by the Democrats and even Obama, you see. And then age is now becoming less of an issue, maybe now more of an issue for Trump than on the Democratic side. So I think Kamala Harris is also playing up her position as a prosecutor previously, right? And how Trump is a criminal. So that would see. So the race is kind of wide open right now, and I think for the U.S. elections, we also have to look very closely at the swing states. What happened in Wisconsin, Michigan, Pennsylvania. So it's really a quite wide open race at this point. And I think a quite wide open race also opens up the room for people to take a wait and see approach. And therefore, I think there's this uncertainty that would likely be happening. But by and large, I think we have to watch for some key, milestones in the run up to the elections. So I think one is the Democratic Convention in August. And then the other, I think we'll probably have another debate between the nominee of the Democrat on the Democrat side with possibly Trump. So there will be another thing to watch, given that I think the recent debate caused a lot of changes in politics, whether this would see some swings in who will win the upcoming election. That's some of the key things that I'll certainly watch out for. And I think for the US dollar, I think you also we discussed quite a bit just now. That kind of depends on what the Fed will do. And I think first half we have seen very strong US dollar strength, but second half, I think with the Fed cutting potentially 1 or 2 times the US dollar strength can be, you can see some fading of that, I think.
Yeah.
Now that you talk about the US election, maybe you could gaze into your crystal ball and tell us who will likely win the US presidential election. Who want to take this first?
I think Sing-Un must be Sing-Un.
Yeah, you want to gaze in your crystal ball?
Okay, hunting point. I'll do what economists always do, on one hand and the other hand as well. So honestly, but I think what we can really say at this point is when we look back, certainly the last few weeks in terms of where and how we got to this point, as Hunting said, when it was Biden versus Trump, it looks like Biden was very vulnerable and Trump a shoe-in for Trump 2.0 presidency. And it was further enhanced after the shooting incident, tragic incident. But Biden has since dropped out. And it looks like anyone who are looking to oppose Trump 2.0 has thrown their money behind the Kamala Harris campaign, and she certainly have gathered momentum. And we have seen the votes or the poll being closer than before, as far as it is Trump and Kamala Harris. So that dynamic has changed. So clearly, as we will have to wait and see how each of the candidate, what they say and do over the coming weeks. 3 months is still a long way, and lots of things can happen. For now, I would say, hard to say, Kamala Harris or the Democrats didn't have stand a chance early on, but at least there is that possibility now of enough people voting against Trump. Remember last election, Trump basically got half the votes. It's simply, counting that way. And there will still be those people enough to give him that support. So it's really whether there are more voters, whether they are women voters or voters with a cause that may just vote against him just because of the name Donald Trump. How it will turn out, honestly, I don't know. I would still say it's a 50-50 race. I certainly will be very wary of a Trump 2.0, mainly again because of his very unpredictable nature. He say a lot of things. He also do sometimes a lot of things as well. Sometimes not consistent with macro 101, but that's him. Whereas the Kamala Harris, the Democrat side, at least likely to maintain continuity, although geopolitical risk in front of in terms of what the party currently support will still be maintained. So at least if I were the U.S. central bank, they would certainly have preferred a Democrat to be in power with continuity in place, more predictability, allowing them to perhaps cut interest rate more aggressively should the economy needs to. But with a Trump administration who may basically open the pump far more significantly than the current Democrat side, then we may see central banks, the U.S. central bank, being more careful about needing to cut rates further if the fiscal side is going to be far more aggressive in terms of spending as well. So my simple answer to that my long answer to that simple question is, I still think it is a 50-50. If you were to push me to say who would likely win, I just support anybody that is not Trump. So it will still be a marginal close fight where the Democrat will probably still retain power for another term. That would be, I think, more supportive. I'm trying to be optimistic in terms of impact for global markets and equities and macroeconomy as well.
So it's a D for you, right? And not an R. What about you, Hunting? A D or an R?
I think I'll still watch and see. Even being pushed, I think, but I'll certainly be very wary of a Trump victory.
I think everybody is businesses, companies, individuals, all very, very wary of a Trump 2.0. Yeah.
But at least we have 1.0 to take reference from. So I think that's maybe one optimistic thing for everyone here, even if Trump wins.
But we don't know. So how you say Trump or Kamala Harris?
I think I'll watch very closely.
Hey, cannot hedge like that lah.
Sides at all, Hunting, you don't want to take sides.
No taking sides.
Hunting is typical economist, left and right.
Yeah. On one hand, on the other
what we
hand.
do is I buy you a beer, you buy me a beer, whoever wins.
Yeah. Let's talk about the investment strategies, shall we? Let's talk about, what is your advice, to all the viewers here on the investment strategies to adopt?
Okay, I could take a first step at it, but Hunting can think about a little while. But I think what I can say is follow the next panel, because that's where they probably will be discussing all these in greater details. Hunting and I, we provide the macro backdrop. So certainly from my standpoint, in terms of the macro backdrop of the last how many minutes, 40, 50 minutes or so, what one we can say is that for now, the macro backdrop still shows that the global economy remains mostly resilient. Yes, we are seeing still some unevenness, especially, say, in the goods producing sector. Post-COVID, we certainly have seen demand for manufactured goods trail off as people spend more of the money on the services side. We certainly see, looking at, say, the global PMI, Purchasing Manager Indices, the global sort of manufacturing losing a little bit of steam after starting Q2 on a fairly positive note. June, it softened a little bit, and the preliminary data for the key developed economies, US, Europe, Japan, and Australia, sees further loss of steam for manufacturing at the start of the second half, whilst the services side still remains resilient. Don't know whether that's temporary or whether demand for AI-related consumer product, whether it be cars or laptops or phone, see further resurgence in demand coming through. Certainly, if we look at the component of the PMI, the order side remains encouraging, which suggests that despite the higher costs associated with shipping goods around the African Cape and higher costs of shipping around, consumers for now are still willing to pay. So that's encouraging. So if that's a backdrop, well, which shows global growth momentum remains still somewhat resilient, although there's some unevenness, then it should be supportive in general of the second half, notwithstanding all the risks that we talk about over the last half hour or so. But clearly, it gives confidence again to central banks that while they've seen the worst of inflation behind us, and we are seeing signs trailing off, there is still some stickiness, which is okay, but it may mean that rate cuts, which are being projected more aggressively, remember, it's the same scenario at the start of the year, with the Fed being projected to cut, 4 times, 5 times, etc. After that 525 basis point hike, a lot more cut to come. They have pushed back on that. So how this get pushed back, I think will obviously depend on the macro backdrop. And behind that is really whether consumer spending remains resilient. If so, I would say it still be supportive of equity market in general. Then the next thing really is portfolio side, depending on whether you're a bit like me or younger one like Hunting over there, your portfolio will obviously be slightly different, whether you're more aggressive or less aggressive, and whether you do, the model portfolio split of 60-40 against a backdrop where interest rate may be coming down. So is fixed income investment still a strategy when interest rate may come up more, or whether it's still holding up? So all these things, I think, it will vary individual to individual or company to company. I would say point to the next session or two where they will discuss it in greater detail in terms of the risk and how a model portfolio should be built for the second half. Because I would say it will change, not just second half, it may be quarter by quarter type, depending on the macro backdrop, inflation backdrop, interest rate outlook, and obviously geopolitical risk as well. So that's my 2 cents worth with regard to asset allocation, portfolio building against the current macro backdrop. Over to you, Hunting.
I fully agree with what Segun said. By remaining quite hopeful of the manufacturing recovery, I think
I hope so too.
tech cycle, I think still remains intact. Hoping to broaden up beyond just AI to more of the mature nodes like in Singapore. Then I think the Fed will probably see 2 cuts, so I'll be looking out for some of the rate cut beneficiaries. And I think the next few panels will give you more light about what are the potential rate cut beneficiaries that might come by over the next few months. But say with some volatility, diversification would help in this environment. And I think, these are the 3 things that I would probably be looking out for.
I think final point here, and I think we haven't talked about, here within Asia, where does China and the Chinese economy play in the recovery or otherwise? My view as far as China and in the Asian context really is, yes, the drag from the household sector, the drag from the deflation excuse me, the removal of the excesses in the property cycle, there will be a drag on the Chinese economy in investment, in consumption for the near term. And that near term could be 3 to 5 years. But unless you believe that China is gone down the tube, I don't think so. Yes, they have some issue, but and policy support are being very targeted, designed to see how it can roll out. So policy response over there may appear slow, but I think they are being very careful in terms of not wanting to throw everything at the economy to reignite another sort of property cycle and property excesses as well. So watching on China is very important. It may take some time for China to be I suppose supportive more significantly of the global equities and global market, but this will happen. And then elsewhere, I will be watching, I suppose, in terms of whether resilience in the global economy remained, apart from the monthly PMI and the subcomponent on cost and production and orders, really is simple statistics on the state of spending, whether the US labor market remain resilient, track the weekly claims, the continuing claims, track retail sales, pay attention to what big retail companies are doing or saying about their sales. So these will, I think, help against a backdrop of a lot of noises, which may still come from the political front, because there will be more noises. You know and confirm you'll get them when you got Donald Trump in the picture. But what is happening actually on the ground with consumer and their income and their spending, and whether businesses are still hiring or laying off more workers, will become more important in the weeks and months leading up to the Fed decision and beyond as well. So that's my 2 cents worth. I don't know whether Hunting has more to add on that.
Shall we keep the last few minutes to the questions posted by the viewers? There was one question on China consumption, which you have already answered, Sing-Woon. Now, there's this question: what is the outlook for the semiconductor industry in the midterm for globally and for Singapore companies?
I think mentioned, I think earlier, or he can elaborate more.
Semiconductor, yeah.
Yeah, I think it's so I think giving some context, 2023 was quite a weak time for the electronics and semiconductor sector. I think because the pandemic period, we saw quite some boost. So in 2024, we are seeing some upturn, rebuilding of inventories, whether it's replacement of smartphones, PCs, and also the AI, related server demand that is coming through. But I've been seeing some of the news that, the use of AI applications are being widened, right? So Samsung has the Samsung AI that's in its phone. Apple is releasing its AI capabilities in its AI phones. So I think there's still optimism that we can hope for this use of AI applications over the next few years. Things like Internet of Things, digitalization would all help the semiconductor demand. So I think there's structural reasons to be optimistic about, the electronics and semiconductor cycle. Even maybe so in the first half, a bit uneven, but I think we can be hopeful for a recovery this year and structural demand over the longer term.
Yeah. We only have time for one last question. I'm mindful of the time. There's just a question here: which sector do you believe are currently undervalued and have the potential for significant growth in the second half, other than the REITs?
We're talking about Singapore market or markets in
they're talking about Singapore market. Yeah. Which sector do you think is undervalued, and there's potential for growth?
Okay, quickly on that side, again, macro backdrop. Hunting and I, we look at things really from the top down. Second panel, they can, I think, give more detail bottom up. So top down, are we able to see a broadening of the growth driver, which we are now? As we said, that let's say in the last in the first half, there are some unevenness. Manufacturing did well, then pull back, tech up, down, etc. But generally, goods producing sector are still on even keel. Services side looks like it is still broadening out trade related. If global trade remains on track, also trade, retail trade, and all kinds of the services side remains, I think, fairly supportive. So I would really be just encouraged by the fact that the broader market in terms of earnings multiple remains very undervalued. And so anything that right on the global growth recovery still supportive industries, I would say remains quite attractive by and large, whether it is in the services side or the manufacturing side, mainly because remember Singapore is a hub. We provide services, goods, and on the goods side, on the services side. So if the services demand remains still resilient against that backdrop, then and dividend story remains intact as well. And obviously, much will depend on whether you are conservative or a more aggressive investor or trader corporate in terms of that macro backdrop being still fairly supportive of the Singapore fundamentals as a hub in the region, which is still experiencing quite good growth.
Now, okay, before I let both of you go, just give me in one sentence your key takeaway, for the second half of this year or even beyond for our viewers here, right? Quick.
For me, it will be macro backdrop, still encouraging, fingers crossed. The interest rate cycle may have peaked, coming down, that's encouraging as well. Just stay alert because a lot of things can happen, like what we have seen in the past, 10 years or so. So stay on your toes.
Yeah, so I agree with Seng-Woon, brace for some volatility. Some good things like interest rate cuts probably are coming, but with volatility, I think this bring opportunities. And probably I'll leave you with one quote from Warren Buffett: be fearful when others are greedy and greedy when others are fearful. And I think, the next few panels will provide you with some more opportunities during this volatility.
Thank you, gentlemen. Thank you. For the rest, please stay on as we have many more exciting teams for you, panel speakers and other C-suite speakers as well, who will delve deeper into the various strategies and insights. So please stay on. And also there'll be lucky draw prizes to be won. Stay tuned. Thank you, everyone. Thank you.
Thank you. Thank you, Han Ting, Seng-Woon, and Melinda for that insightful sessions. Next, we will have a discussion on the analyst take on value portfolio with Chi Zhengfeng of DBS Bank, Ong Kan Chuan of CGS International, and Moderate by Timothy of Dollar and Cents. To watch the sessions, head over to the Programs tab on the SGGEM website and click on the Watch Live button that is beside the sessions. So if you encounter any issues, you can refer to the User Guide tab on the website for more information. So we will see you over at that sessions. Thank you.